Hey guys, welcome back to the Thinking Macro Show. I'm your host, Austin. I'm an accountant who used to work for the Big Four in asset and wealth management, and today we're going to be taking a look at the interesting case of Disney. Has the valuation changed? Has the story changed? We know that there's been an election of the new CEO, Josh D'Amaro, who was the former head of parks in Orlando. And now, is it time to revisit the story of Disney? Over the past 5 years, if you've been following this company, it's been effectively dead money. Since 2021, the Disney stock has lost roughly 41%, while the S&P 500 has returned 77% within that same time period. And it's crucial and integral to kind of look at the reasons why this is, how the market has been viewing Disney stock, what the actual financial performance of Disney is, and we're going to get into that today by looking at the income statement, the balance sheet, the statement of cash flows. And then also to what it means for Disney with the new election of the CEO being the former head of parks. And then also finally, why I think that the market is fundamentally misunderstanding the business of Disney, but then also simultaneously why I remain cautiously optimistic towards Disney and not extremely bullish at these current price levels. So without further ado, let's get into this. So when we think of the Disney company, and I'm sure that you've probably thought this way before, we look at a business that in the 20th century was a media superpower. Right? This business is too big to fail. It has all of my favorite franchises. It tends to release movies that resonate with families and create these emotional attachments that exist with people throughout their entire lives. But it's almost as if the 21st century Disney company is a husk of its former self. Right? They consistently release movies that fail in the box office. It's almost like they're continuing to make decisions that further alienate themselves from this core consumer base that is this family-oriented motion picture entertainment business. So there is real credence to the idea that if we just look at Disney's business from this one particular side that is their media side, then it begins to make sense how the market is viewing the company of Disney. And in order to understand why the market is pricing Disney the way that it is, we need to back up a little bit and explore the economics of movie making prior to the streaming wars. So the thing is, movies have always required significant amounts of capital to make. Let's take Titanic, for instance. It took roughly $200 million to produce, and then they spent $50 million in marketing, made $1.8 billion in the box office. The thing is that movies used to move through this pipeline. First, they would be produced, obviously, and then they would hit the movie theaters. And the movie theaters would typically take roughly about 40% of the total ticket sales. And then after the movie theaters, they would move to DVDs. And this was the real profit engine for a lot of these media studios, right? Because if you look at it from a fixed cost perspective, from a unit cost perspective, it would cost roughly 75 cents per DVD to make. And then they would charge $20. And all of that was profit that would go into the studio's back pocket. And then after that, it would move into cable syndication. And so movies were moving along this specific trajectory where revenue was at least forecastable. And if a movie didn't do as well in the box office, you could hope for, or at least count, that it would do better on the DVD sales side thing. But then what happened was after Netflix's streaming started to gain momentum with the consumer, this changed the economics of movies significantly, right? And pair this in tandem with the fact that movies are now costing much, much more to make. For instance, Star Wars: The Rise of Skywalker, I think cost somewhere in the range of $600 million to produce. And if you guys are Star Wars fans like I am, then you've probably seen the movie and you probably...
Somehow Palpatine returned.
So the thing is that movies went from having this particular streamline to suddenly just releasing in theaters and then immediately going to streaming. And it's really been streaming now that has upended this DVD market, this additional revenue windfall that these legacy media companies had. So for instance, if a movie had failed in the box office, then legacy media studios could, in some level, hope that they would succeed on the DVD sales side. But streaming has really changed all of this, and it's important that we kind of touch on this now, how it has. So Netflix first started off as a DVD rental business in 1997. You would effectively go onto their website and you would purchase a DVD for rent, and they would mail you the DVD, and it would arrive and you would watch it and you would send it back. And that was their business model before they went into streaming. And then when they transitioned into streaming, what started to happen with these legacy media studios is that as Netflix began adding more content to its library, by which they would have a massive library, and then for a fixed cost every single month, a consumer would pay a price to be able to access this content library. The legacy media studios would collect a licensing fee. So they would pay a licensing fee to Netflix to be able to, license their content on Netflix's platform to have this consumer watch. But part of the reason why we started to see the streaming wars is because of what this meant in terms of data. So Netflix began to collect data on the customer profile. They began to collect the data on what people like to watch, what they didn't like to watch, how long they watched for, the gender of particular shows, what gender liked more of one particular show compared to another type of show. And all of this was valuable data. And what the legacy media studios started to fear was that because Netflix had access to this data, they would eventually start to produce their own shows. And then this would end up commoditizing the legacy media content, basically. And what they also started to realize too was that there was a huge consumer base that wanted streaming. So all of these various legacy media studios started pulling away from Netflix in this fear that their content would get commoditized, and started storing it on their own streaming platforms. But the thing is, to create a streaming platform, you need two things. You need a lot of capital, and you need a massive content library. And you also need that content library to be engaging, to be enticing, to entice subscribers to subscribe to your platform. So what this means is that you need new and novel ideas, and all of this also requires additional capital. So this kind of goes into now what we're going to cover called the content asset spend. If you take a look here at the 2025 balance sheet for Netflix, we see an asset account called Content Assets Net. Content assets are all of those assets that make up the streaming library for a lot of these streaming platforms. They include the assets in pre-production, the assets in production, the assets in post, the assets sitting on the library, and all of them are summed into the Content Assets Net account on the balance sheet. Now, what's really interesting here is if you take a look at the statement of cash flows, which for those of you who might not know, the statement of cash flows is the financial statement that tracks the actual physical flow of cash in and out of the business. And this differs from the income statement because the income statement can sometimes have non-cash expenses or one-time items allowable under GAAP, whereas the statement of cash flows tracks, quite literally, it follows the cash. But what's interesting here is that if you take a look at the statement of cash flows, you can actually track the capital expenditure that a lot of these legacy media companies have been spending. So the way that we do this is that we take the beginning balance of the content asset account at the beginning of the year, and then we add back amortization because that's one of those non-cash expenses we just talked about. And we take the ending balance at the end of the year, and that actually gives us our content additions, our content asset additions. So what's really fascinating now, kind of drawing the nuance out of this, is that from 2020 to 2022, we saw Netflix's content asset spend skyrocket. And we watched all of the other legacy media companies follow suit as well. We watched them also invest heavily as they were all building their own streaming libraries, really kind of putting arms to the streaming wars, so to speak. But then what's really fascinating is in 2025, we're starting to notice that content assets are starting to normalize, which to some analysts, they would say that this means that streaming offerings are beginning to normalize and that there's not going to be as much investment into streaming in the future. And some other analysts believe that because of the nature of the economy right now, that the cost to produce movies have just skyrocketed. So that's causing these studios to kind of reel back a little bit. But what's interesting, and the reason why I look at this specifically with Disney, is that we're watching Disney also sort of halter back on their content asset spend a little bit as well. But then why does this matter, you might be asking? So one of the biggest things is that because of the massive amount of capital that's required for movies nowadays, this is causing movie studios to actually play it more safe when it comes to new movies that they're going to be putting out into theaters. And they're actually prioritizing franchises. So this specifically plays into my Disney thesis because Disney spent the vast majority of the past 2 decades acquiring IPs that have massive emotional connections to their audiences, right? So they own Marvel, they own Star Wars, they own all of these various different things. Now, as you guys know, I'm a Star Wars fan and I haven't really exactly been the happiest with how Star Wars has been treated over the past 10 years. But with that aside, looking at the thesis here, what we're noticing is that like studios by and large are all trying to move into this sort of franchise model that Disney has really locked down at the moment with Marvel. And this specifically ties into the actual part of the business that I'm most interested in right here. To which, and this is the reason why I remain cautiously optimistic, however, this is the crux of my thesis here. It's actually, I think that Disney's strongest element of their business is actually their parks and experiences segment. And let me explain to you why. So under Bob Chapek, he tended to treat the parks and experiences segment of Disney's business almost as like the legacy cash cow. So he would use a lot of the profits that were being made from that part of their business and would invest it heavily into streaming. But what we're seeing now is that the parks and experiences segment, specifically under Iger as he made Disney more lean, the parks and experiences segment actually are returning a significant amount of operating cash flow, which is directly producing significant amounts of free cash flow in Disney. And so what I actually want to see, and the reason why I'm rather excited that the content asset spend for streaming has normalized, is I want to see a lot of this cash that would otherwise be pledged towards Disney Plus, that I do genuinely believe that Netflix is ultimately the key distributor of the streaming wars. A lot of this capital that would have otherwise have been pledged towards Disney Plus, I want to actually see instead reinvested back into the parks and experiences segment. And why the parks and experiences segment interests me so much is that as more media comes out to compete for people's attention, right? Like we have all of the different streaming competitors. We have YouTube, we have books, we have music, we have video games, we have all of these different things, and also introduce the fact that AI could eventually come around and actually commoditize a lot of this content. Also, I actually am very interested in the parks because of the fact that the IPs almost serve as a way to get the customers in the door, right? So you have an emotional attachment to Darth Vader or to Captain America or to Iron Man, and Disney decides to build a world dedicated to this particular character. And we're actually, not even you, we're actually seeing this in the data of people who spend money at Disney parks. They're oftentimes older adults who formed these childhood attachments to the Disney parks and they want to bring their kids to experience the same kind of thing. You're most likely to come back and to continuously spend money and be a repeat customer to these parks and experiences. And what we're actually seeing is that Disney has a significant amount of pricing power with this. And we're also watching the consumer base that tends to consume the parks and experiences product. Not only are they willing to pay this amount, but there's also a dedicated following, otherwise known as Disney adults, of people who are willing to pay almost any kind of amount for these theme parks. And I don't think that we should underestimate the power of the brand that really rests here, especially from an investment thesis perspective. But as with any investment thesis, we always have to explore the risks, and these risks are the reasons why I continue to remain cautiously optimistic with Disney, even as I believe that the parks and experiences are a very, very, very strong core key component of the business. So funny enough, the first risk isn't even in as much of a risk as it is more so an observation. So if you've been reading any articles about Disney, you know that they've pledged, I think it's roughly about $60 billion worth of capital expenditure over the next 10 years. But what's really fascinating is I absolutely love the bond market. Granted, and admittedly, I'm not an expert in it, but I love to research it and I love to see like the yield curves and also debt offerings and what these could potentially be offering. And what's really fascinating is if you look at the corporate bonds so far for Disney, you see a lot of 8% coupons. And so immediately this makes my mind go, okay, if they're issuing debt at 8%, and if they're issuing debt at high interest rates, first of all, is this debt callable, which means that they can refinance it? But then also secondly too, what is the return on invested capital we would need to get in order for an 8%, in order for a bond that has an 8% interest rate to be accretive in value towards Disney, right? But now if I'm a debt investor, I'm looking at this and I'm seeing that Disney is offering bonds with an 8% coupon rate, right? And what I'm also thinking is that, okay, right now we know that companies are all investing in AI, and we know that interest rates oftentimes compose of inflation expectations and then also business need, investment need throughout the economy. So I'm also looking at this too, and now I'm saying, okay, I could get an 8% coupon and potentially pay a premium over par for that now, with the expectation that potentially rates could drop in the future. And what would end up happening is that as these rates drop, now Disney refinances a lot of these debts potentially if they are callable. But if they're not callable, I'm holding on to a bond that has an 8% coupon that now that the interest rates have dropped, Disney's debt is now offering me a 2% coupon, which would in theory spike the premiums, right? So it's sort of that duration play that also factors into this simultaneously. Now, granted, for me, there's a lot of risk with investing in the bond market, specifically because I'm not an expert in the bond market. I absolutely love it. I love to see the yield curves, and I love to kind of see what, banks are doing with their bond portfolios and other things. But admittedly, I'm not an expert in the bond market. So I typically tend to kind of stay away from these duration trades. They're not exactly my bread and butter, so to speak. But again, looking at this from an equity holder's perspective, what kind of return on invested capital are we going to have to see in order for an 8% coupon, in order for a bond with an 8% coupon to be accretive in value towards Disney, especially as it relates to future cash flows and the eventual performance of the stock? And then focusing on the actual risk here, we need to look at the macroeconomic risk of the middle class, right? We know that prices for everything are skyrocketing. If you've been to a restaurant lately, it is crazy how expensive it is. It's absolutely crazy. Even McDonald's. I remember the days when McDonald's used to have $1 to $2 cheeseburgers, and now they're what, $8, $9? Right? So all of these various factors will probably have an impact on people's pocketbooks and their ability to spend on Disney's parks and experiences, which is why what it really comes down to is the strength of the Disney brand at the end of the day. It comes down to the strength of the IPs. It comes down to that emotional attachment and whether or not Disney's management can actually execute on monetizing that emotional attachment. Hey guys, thanks for staying tuned to the end of another episode of the Thinking Macro Show. I'm your host, Austin, and as always, it's been a pleasure, an absolute pleasure, being able to record for you guys today. Please leave me a comment in the comments section below, letting me know your thoughts on Disney. Specifically, if you think that Star Wars could potentially have a comeback. So take care. Bye-bye.